A governmental insurance pool functions as a collective governance mechanism where members decide which specific risks they are willing to absorb together. That collective protection requires precise boundaries. A pool cannot absorb every hazard thrown at it without a structured defense. That defense begins with underwriting. Underwriting acts as the gatekeeper. It is the active, analytical process of evaluating, classifying, and ultimately deciding which exposures are allowed to enter the collective in the first place. Once a risk is admitted, rate-making takes over. Rate-making is the actuarial process that calculates the expected cost of those accepted risks and allocates the financial burden across the membership. You can see the objective in this balanced scale. The pool must constantly weigh two opposing forces, risk-sharing and risk-bearing. Risk-sharing is the portion of loss collectively funded by the entire membership. Risk-bearing is the financial penalty retained directly by the individual member through deductibles and retentions. A board's primary fiduciary duty is to maintain that balance for the structural sustainability of the pool as a whole. It is not to accommodate the unique financial desires of any single participant. Looking at this cityscape highlights a structural challenge. The exposures generated by a high-density urban environment are immense. Yet public pools are inherently non-homogeneous. They group complex, high-risk municipalities alongside entities with vastly different scales, legal environments, and operating cultures. The daily hazard profile of a heavily policed urban center bears almost no resemblance to the routine, predictable operations of a small rural utility district. Given these massive discrepancies in size and exposure, how do you determine a mathematically equitable rate for everyone inside the collective? Simplistic, equal pricing is dangerous. If every entity pays the exact same rate per unit of exposure, the well-managed, safe members will permanently subsidize the reckless members. The inverse is equally destructive. If members only ever pay for their exact past losses, the mechanism of collective risk financing collapses. The pool degrades into a simple, reactive bank account. True equity requires an actuarially sound allocation. Rates must be calibrated based on measurable future exposure, adjusted precisely for differences that actually drive expected costs. Consider a common boardroom dispute. A small municipality reports 0 claims over 3 years. Based on that clean record, their leadership demands a massive rate reduction, claiming excellent management. To evaluate that demand, actuaries apply the concept of credibility. Credibility is the statistical weight assigned to a member's actual loss experience when predicting their future costs. The difference in statistical credibility is exposure volume. Here is member A with a single vehicle, compared to member B operating 10,000. Over 12 months, member B generates massive, highly predictive risk data. Member A would need 10,000 years to match that volume. This exposes the harsh reality of low-exposure members. A small entity with a clean record might possess excellent risk controls, or they might just be statistically fortunate. Their data lacks the volume required to prove which is true. Aggregate thousands of low-exposure members, and the class becomes highly predictable. The collective glows with statistical certainty, even though predicting the next individual loss remains random. Therefore, actuaries keep individual members tethered to the collective, blending their sparse experience with the established class average. Rewarding a non-credible clean record with deep discounts conflates luck with management. It mathematically guarantees that the broader collective will subsidize the shortfall when that member's inevitable loss finally occurs. A rating formula that overreacts to short-term data creates systemic danger for the entire pool. If unchecked experience modifiers dictate the price, the resulting financial volatility will cause the collective structure to collapse under sudden premium swings. Management can implement training to control the frequency of routine claims, like slip and falls. They cannot entirely eliminate severe, fortuitous events, such as a targeted cyber attack or catastrophic weather. To maintain solvency, the price must be anchored in measurable baseline exposure, like total payroll, property values, or vehicle counts, rather than reacting exclusively to the past few years of claims. Actuaries stack the calculation for stability, a base exposure block topped by an experience modifier. Pools apply a rigid lock, mandating 70% of the charge comes solely from operational scale. Actual loss history only expands or contracts the remaining 30%. A claim-free period does not eliminate the physical reality of the exposure. The municipality is still dispatching vehicles, operating utilities, and serving the public. The opportunity for loss remains active. A mathematically sound floor ensures that tomorrow's looming exposures are fully funded today, regardless of how fortunate the member was yesterday. Ratemaking allocates costs, but it has strict limitations. A pricing formula cannot fix flawed operations or a broken safety culture. Those operational failures manifest as high flyers, members with persistently adverse loss ratios, high claim severity, and deep risk control deficiencies. When the data reveals a high flyer, calculating their rate is no longer the primary objective. Simply charging a higher premium allows a severe structural hazard to operate freely inside the collective, threatening the pool's capital capacity. The board evaluates threats on a precise risk matrix, tracking frequency against severity. Routine property damage or frequent low-cost slips sit safely left as predictable, shareable costs. But an uncontrolled, high-severity pattern pushes a member into the upper right quadrant, marking them as an unacceptable risk. To restrict that risk, management deploys specific underwriting levers, non-rate interventions engineered to force accountability. These controls adjust the boundaries of exactly what the pool will cover. The first lever is imposing higher self-insured retentions. By raising the retention, the pool forces the member to fully absorb the initial impact of a claim out of their own budget before accessing collective funds. The second lever is quota sharing for severe losses. Instead of the pool paying the entire remainder, quota sharing mandates that the offending member continues to pay a strict percentage of the ongoing financial damage. The third lever restricts specific hazards using coverage sublimits. A sublimit establishes an unbreakable ceiling over highly volatile exposures, capping the absolute maximum payout the pool will tolerate. These interventions require the member to keep vital skin in the game. It ensures they directly experience the financial consequences of their own administrative failures. There is a final boundary in governmental pooling. The collective does not have to accept or renew a risk simply because the applicant is a public agency. Government status does not confer an inherent right to endlessly extract capital from peers. If a member refuses to implement safety controls, or if their hazard profile exceeds the underwriting levers, they must be excluded from the pool. Removing a toxic exposure is the ultimate act of fiduciary responsibility. It preserves the integrity of the collective structure for the entities operating safely within it. A sustainable pool requires exact execution. It relies on rigorous statistical analysis, strictly enforced underwriting boundaries, and absolute clarity on risk distribution. True fairness is not found in equal pricing or unlimited grace. It is found in protecting the capital of the collective whole.